How many people now?
Uh, Let me see. Hold on 1 second. Perfect. Around 12 to 15. So
That's
I
great.
I have seen I'm seeing some people here in the chat, so feel free to look at the chat if you want to, Aldo, as well. They have their name and what they do. And the floor is all yours, Aldo. Welcome.
Thank you. Thank you so much, Linda. Thank you. It's a pleasure to collaborate with you and Seed Spot. And I'm actually elated, right? We got over 12 people want to talk about money, right? Cash. I'm sorry, I think somebody's got your mic on. Maybe it's the voices in my head. But anyways, I am here to talk about cash flow and staying profitable for you guys that are newer business owners. I appreciate that you guys are making comments, introducing yourself, Ricardo, CEO of T, the world, Jessica, awesome, new startup, Yadira, working with personal growth. That's awesome. Thank you so much for coming here. I know sometimes talking about businesses and growth and everything else is awesome, and sometimes we shy away from like the cash perspective, right? I mean, we're all here in business to make money, to be profitable, and I'm glad that you guys are here. I love the title. I didn't come up with this. I'm gonna thank you guys at Seed Spot to come out with that because uncertain times is something very prevalent in the business industry. There is really no certainty. You could be riding the wave on top, and tomorrow you crash, and it's peaks and valleys, as they call it. So again, I'm pretty glad that you're here. First and foremost, let me tell you a little bit about myself. And there it is, new picture of me. Hope you like it. I am a licensed CPA here in Arizona since 2004. So it's, oh God, 22 years now. I guess my license can buy beer now. That's great. I am the founder and the owner of Aprile CPA, PLLC. My practice focuses on tax planning for businesses in the construction industry. And what I do is very simple. I help business owners in the construction industry reduce your tax bill by applying tax strategies that make sense and that they are legal. That's what I do. But I have a myriad of experience. I work with very large organizations like American Express, GE, and also very small businesses. The reality is I love working with decision makers at the small, mid-sized level. That's really where I find myself. I love giving back to the community. Here I am with Seed Spot. I've also worked with Cahoots, the Better Business Bureau, Local First Arizona, et cetera, et cetera, et cetera. I went to ASU, so Grace on Devil, great. If you went to U of A, that's okay. There's love for everybody. In my spare time, I love grilling, cooking, and traveling with my wife. Those are my passions. Oh, yeah, there we go. So I got my social media. If you want to follow me at Aprile CPA, Facebook, LinkedIn, Instagram, I'm posting videos about tax tips and other accounting tips or just life in general. So if you want to follow me, that'd be great. Free to join. So very cool, I say. And before we get started, I want to give you a disclaimer. This is informational purposes only or entertainment purposes only. Now, you think this is entertainment, please get some help. But this is informational purposes. This should not be construed as tax or accounting advice. Always check with a professional before taking action. With that out of the way, let's get started. All right. So, the number one businesses fail, small businesses, it's not because you have a bad product. It's not because you're not a good business person. Sometimes it's because you run out of cash, right? As a matter of fact, this is 82% of small business fail due to cash flow problems. That's coming from the a U.S. bank study through the score.org. So that's really it. Sometimes you just don't have enough time to prove your business, and before your business becomes a proven concept, a proven product, you run out of cash and you have to fold and dissolve the business. So that's one of the deals. That's why I always say if it was that easy, everybody be doing it. So hats off to you guys that have started a business and are trying to make it happen. Right? Not everybody does it, so it takes a lot of courage and a lot of effort to make that happen. So let's be cognizant on that. Now, I'm not sure what your current situation is. As far as I understand, most of you guys are new startups. Is that correct? Would you say show of hands? I think you can do show of hands here or not. Forget. And so what happens is we're like so busy trying to make money, to right, to get business or whatnot. But sometimes we shoot ourselves in the foot, meaning we'll just take whatever deal we can get, we just sell it at a deep discount or whatnot, in the hope that by getting volume, being busy is gonna be profitable. But there is a no joke actually goes back to like manufacturing times where it says, it's I lose what is that? I lose a penny on every unit that I make, and I plan to make it up in volume. Meaning you can generate a million, 2 million, $10 million in revenue, but if you are operating at a loss, you're just accumulating a bigger loss. So that's really not where we want to be at. So what does that mean, right? We got the three things we need to look at: revenue, profit, and cash flow. Now, I just want to make sure, and to some of you, this may sound very basic, but I still want to drive that message home. Revenue and profit are not the same thing. Revenue is the top line, meaning your sales, your gross income, your revenue, meaning whatever money is coming into your business. For example, I'm a CPA, right? It's whatever I invoice my clients. My profit is what's left over after I make all my payments to all employees, providers, services that I have, rent, any business related expenses. So that's the profit. And hopefully that's, in the black, right? So that is really objective. So I talk to people and say, you know what? I have a great business. I make $1 million. Okay, what does that mean? Is that $1 million in sales or $1 million in profit? There's a big difference. Okay, so I want to make sure that we all understand that. And when you talk to somebody too, it's like they get a little clarity in that. Are we talking about top line or bottom line? Because having high top lines is nice, but having a high bottom line is even better. So I'll give you an example, right? I've met people that they make $500,000 in sales and their net profit is $300,000. And I met people that have $1 million in sales and their net profit is $100,000. Which one you rather be? Believe it or not, some people will choose $1 million in revenue, but $100,000 in profit, because you know what? Having a $1 million business has a nice ring to it. And again, I'm not here to judge. I'm just here to put things into perspective to see what makes the most sense to you. Now, cash flow. Cash flow is very important. Now, some of you guys, I see it's, may have more cash flow issues than others. So, for example, if you are in the construction business, right? Sometimes you get a project or whatnot, you gotta complete the project. In the meanwhile, you gotta pay your employees, you gotta buy materials. So it's all cash out, not cash coming in. And then you invoice the client, and then hopefully they'll pay you right away. Or if they delay, it's not 30. But guess what? Between you already laid out all the money out, and now you're sitting waiting for cash, and then you got more expenses coming out. So even though this project may have been a profitable project, you may feel cash forward and like, crap, I don't know what the heck's going on. I have this project, I sent out the invoice, and on paper, I should be profitable, but my pocket says otherwise. So we want to make sure that we are preparing ourselves to not put ourselves in that situation. Now, other type of businesses like restaurants, you collect the money right away, right at the bat. So that's not an issue, right? Money coming in or whatnot. But at the same time, you are also paying for your expenses right away, right? I put it on a credit card, this or that. So you want to make sure that really the key is money coming in, you make it as fast as possible. Money coming out, you slow it down as much as possible. So you are always in the black, not in the red. Because what happens is if you have a lot of receivables out there, you spend a lot of time and energy trying to collect that money. And that's time and energy that you could be investing in your business to make it grow. Now, that's what we're talking about. Now, how the money moves through your business is money comes in first. Now, again, there are different types, sales, invoices, depending what kind of business you got. You're in the service business, I strongly suggest you collect the money up front. For example, me as a CPA, for my clients, I both my services, I send out an agreement and I collect my money up front. So now I know that my service is already paid. Now I have to perform. So that gives me the ability to perform as fast as possible so I can deliver the services that I've been provided, right? Restaurant is the same deal, right? Most instances, you either collect before or after the meals are served, but that's going to happen within the hour. So that's great news. Usually people put in a credit card, you wait a couple of days and you get your money, right? Now, usually money will sit in a bank account, right? You collect the money and put it in your bank account. Uh, if you haven't done so yet and you're running a business, I suggest you open a business account. That could be through your current bank, uh, credit union or whatnot. But I always tell my clients, make life easier on yourself and make life easier on your tax preparer, your accountant. So have all your business activity go into a business bank account and Um, don't commingle your business activity and your personal activity because down the line it's going to become very muddy and you may forget what expenses came out of where or how. And what I've seen people do is, oh, you know what? I got to buy XYZ. I just put it on my personal credit card. You pay for it, you forget about it, and you never deduct it from your taxes. So you shoot yourself in the foot sometimes. So money sits, and then unfortunately, money has to go out. You gotta pay rent, you gotta pay for supplies, payroll, taxes, or whatnot. Timing is everything, guys. Timing is everything. So again, in the ideal world, you want to collect your money in first. You want to sit on that money, and then the money goes slowly. But we live in the real world. Sometimes we do have to spend the money first. As a restaurant owner, you gotta buy supplies, you gotta pay the products, you gotta get people on payroll and it's money coming out, coming out, coming out. You open your doors and you hope that people show up, buy your food, and then you're able to get that money back. So that's what's going to take a little discipline. So here are some common cash flow traps that I've observed in my experience. Pay now before you collect. So again, for restaurants, I get it. This is what it is. But let's say you're in the construction business, right? Maybe if you go to a service or a job, at least collect a deposit, right? 25%, 50% of the project. So you know you have enough money and commitment from your clients that they're going to be able to pay you. Saying again, me as a CPA, my practice, I collect upfront for my fees. If that doesn't work for my client, then I'm not the right fit for them. And that's okay. Everybody's got a different flavor and flow, how to do things. Define what works for you best. Now, the other thing is over investing in inventory. Sometimes I see people in the construction industry, the restaurant industry, they just buy too much of whatever supplies they be. So that creates for restaurants waste, rotten food, and materials could walk out the door. That, if you have employees or not good security in that. The same thing could happen with construction, right? You could have too much materials, and if you don't have the proper controls, they could spoil, they can go bad, and they can grow legs and walk away. But another important thing is now you pay for these materials, inventory, supplies. That means that whatever money you had in your pocket had to go out to pay the supplier, right? The other thing what I think is confusing a good month. This is what happens sometimes. Now we're talking about that example where the construction company provides some services or works on a project. We have the cash outlay to pay for the materials, all the labor related to that. No deposit was collected. And let's say in April, that's when that happens. And I issue my invoice in April, at the end of April. Well, if I look at my P&L, this is a bad month. I haven't collected any money, and all the money has gone out. Now, fast forward to May. Oh my goodness, I got all this money coming in. So it looks like May was great and April was bad. We want to make sure that we're matching the activity to the result, because otherwise, a year from now, we're going to look back and say, well, why was April so bad and why was May so good? Make sure you keep notes on that. Another thing that I've seen, especially in the construction industry, but really any other type of businesses, especially when you get a big deposit, oh my God, I look at my bank account, I have paid all my bills for April, but this good deposits because you got a large contract you're supposed to perform for the next 6 months. So this money is supposed to last you for a while to buy supplies and pay for labor. But I see all this cash. You know what? I've been working hard for the last couple of years. Time to treat myself. Let's go on that vacation. Let's get that new truck. Let's go shopping, whatever it may be, and you blow through the money. Then in the next few months, you realize you have to make those expenses. And well, there you go. Now you're in a crunch for cash because the money that you thought was profit is not profit. Actually, it's money that already was predetermined for expenses down the road. So watch out for that. Now, know your numbers. This is what it is. I know accounting may not be the most glamorous thing. Even if you don't have a bookkeeper right now, if you keep track of your business activity in a business checking account, life is a little bit easier. You can dump this information into a spreadsheet and separate that, sort it out by money coming in and money coming out. You need to know where you stand to see if you're making money. And I suggest you do this at least on a monthly basis. If you have a bookkeeper, ask him for financials on a monthly basis. And I didn't write this down here, but these are the most important financials. Is the P&L, which is the profit and loss or income statement, the balance sheet, right? And the cash flow statement. Those are your top three. You wanna check on that. Now, where do you see the cash on hand? On the balance sheet. So this month is going to wrap up on April 30th. You're going to look at your balance sheet. It says cash on hand. That should be an asset. You got to know how much money you've got sitting there. Also, another asset on the balance sheet is going to be money owed to you, or call accounts receivable if that's what you got. That's important because I've seen people working on projects. Hey, I'm busy. I'm making money, this and that. I'm sending out my invoices. I have no money. And the reason why you have no money is because no one is sending you payments, or not all your customers are sending you payments. Some of you may be surprised, but some people have a bad habit. They won't pay you unless you are a pain to them, a pain in the neck. You send another invoice, yeah, whatever. I'll pay them when they bother me again. And I've seen accounts go net 30, net 60, net, 90 days past due. And the longer you go past due, the harder it is for you to collect the money. So protect yourself. Send out the invoice. If you have something like QuickBooks, you can have automatic reminders that will go out if you don't receive the payment. So make sure that's enabled. But it gets to a point that is critical. Talk to the owner, talk to the person who's going to pay you the bills and say, hey, what's going on? I see the invoice. You're happy with my work. Make sure that you are getting paid for your services. I've seen this way too many times where people have outstanding receivables and their clients are past you 90 days, but somehow they don't want to collect because you don't want to be the bad guy. But the reality is these people are using you as a line of credit. They may have issues or troubles. They may have a hard time because they didn't collect money or whatnot, and you can empathize with them. But a conversation is warranted, and also a way for you to figure out how you're gonna get paid. Because at the end of the day, you're in business to make money, right? Now, let's talk about the not so much fun part, which is the money you owe. Just like you're expecting to get paid on time, you got people that, well, you gotta pay on time. You may have loans, you have a credit card bill, rent. You have people that are employees. You should definitely want to make sure that you pay them on time. You have contractors that you pay. You want to also make sure that you take care of those people. And again, have that conversation with them to make sure that the conversation is open and everybody understands what they should be expecting from you and them. Right now, it's also very important you know what your break-even point is. The break-even point is nothing more than knowing how much money it takes to keep your business operating. So again, if you're a restaurant owner and you know what your rent is, having a good idea what your utilities are going to be, what your payroll is going to be, what your supplies are going to be, food stuff that you have to buy from Cisco or whomever else you got to buy. You have a good idea. Let's say a small restaurant, I don't know, $20,000 a month just to keep that small restaurant running. Then you got to at least make $20,000 to keep the business running, and that's you not making a profit. Sometimes not even collecting money yourself to pay for your own bills. Now, calculate your cash right away. Basically means how long can you survive without having no money coming in your business? So let's say if you stop receiving money today, how much money you have in your bank account to pay for your expenses today? So for example, you got $8,000 and you stop collecting money and you have average of your expenses are gonna be $3,200. You got about 2.5 months for you to pay your expenses. That's how much of a lifeline your business has before you run out of cash. Now, obviously, that's not counting the fact that you may have a line of credit or you can borrow money from somebody else. But remember, at that point in time, you're getting yourself into debt. So your monthly expenses, not only for your regular operating expenses, but now you're adding that. So that's going to go up or whatever it is. So you ideally want to have 2 to 3 months of reserves, operating reserves, so you don't have that much pressure on you. I've seen clients, unfortunately, where they spend their Wednesday, Thursday running around and trying to figure out how the heck they're going to make payroll, right? So all the time they're spending all their time figuring out how the heck to get money, getting loans at a really high interest rate so they can make payroll. And don't get me wrong, it happens. What I'm trying to say is, hopefully that's an exception, that's not the rule. If you're operating your business and this is something that is common practice to you, it's time to do a reevaluation of your expenses and see where you can make adjustments on your money coming out so you don't have to invest that much time and effort chasing money so you can make payroll. Now, how do we improve cash flow, right? Number one is get paid faster. That sounds easier said than done. Hold on, I'm moving this. Now, depending what kind of business you're in, you can shorten payment terms. Of course, for restaurants, it's very straightforward, right? You provide the food, you get paid the same within the hour at worst. That's not an issue. But if you're in a different kind of service, you're a service provider, you're in the construction industry, you are providing any type of service or selling a product, make those payment terms as short as possible. I would say if you can collect the funds in advance, that would be ideal. I mean, some business you cannot do it, but if you can, you're in the retail business, if you're selling online, collect the money right away, right? Sometimes people will negotiate with you, especially in construction. Can they pay you net 30, net 15, net 7? But make sure that that's what they mean. I see, construction companies, a general contract or a sub going to a general contract and say, yeah, we pay net 30. But in reality, their practice is they pay you 90 days because that's how they operate. So number one is there has to be a good conversation about whether they're going to be a net 30 or net 90. And if they're going to pay you net 90, then you might want to increase your prices because, again, they are using you as a line of credit. You not being able to collect net 30 as agreed to and adding another 60 days, it's free financing for them, money that they don't have to borrow. So basically, you're giving them interest-free money for a 60-day period. So watch out for that. And again, I understand sometimes we get excited and, we're looking at a bigger guy and they're giving us business. Yeah, they give us business. They take forever to pay us, but they pay us. But that's going to create a lot of hurt down the line. So you really want to watch out for that because while they are 60, 90 days late, you have to come up with the money to pay your bills at the business level and sometimes at the personal level. Okay.
Sorry, yes. To interrupt. Somebody has a question. Do you want questions now or at the end?
I think at the end, unless it's very specific to this, or if it's not, yeah, go ahead. Go ahead with your question, Stephanie.
Yeah. Hi. About the net 30, is it unreasonable to think that that's even too long?
Absolutely.
Because if you are consulting and providing a service and then they're waiting 30 days to pay you, like, bro, I already did this work 30 days ago, you know? So what do you think about what do you think about managing expectations at the beginning for
From the
that?
get-go. Absolutely. 100%. Again, I'm a consultant. I'm a CPA. I do tax planning. I provide my clients a quote and they sign the agreement. And next thing they know is they get an invoice and they pay me. So because I've been on the other side of the situation, I provide the service, like you stated, and here I am waiting. So, all right, 30 days have gone by. I haven't paid. And the reality is, no one can afford that based on an understanding that you are supposed to get paid right away or net seven or whatever it is. So I think is what is your intention? And it's tough to navigate, right? Because sometimes, especially as a new business owner, it's like, oh my God, I'm getting a client here. Whatever it takes, I'll get that client, offer a discount, offer great, net 30, very flexible payment plans or whatnot. But then that may come back and bite you in the rear end. Uh, because at the end of the day, like you say, right, you're already out 30 days, and if they go past you on that, you still get to pay bills as a business owner and as a for the business and for yourself personally. So be upfront, especially about your expectations. This is your business. You get to write your own rules. And if somebody says,
Mhm.
"Hey, I pay people, net 30," well, unfortunately, I'm sorry, I can't work with you, right? You can negotiate. So move from net 30 to net 15, net 7, or my favorite, collect money up front. I'm a big fan of collecting up front if possible. Right? And I understand there may be instances that's not the case, right? But again, that's my objective. Now, if you're in the construction industry, or even if you're a consultant, maybe you can collect 50% upfront, right? I mean, not everything is black and white, but you need to find some way to collect that money, or even like a progress billing type of deal, right? You get a longer project that is not a short project, 6-month project, and you have this gosh, the word is basically at some point in time, if you complete X number percentage of the work, percentage of completion, there you go.
Yeah.
Then you collect, send the invoice and get paid right away. But the worst position to be in is net 30, and especially with somebody you already know that they are late at paying you the bills. I call those toxic relationships. And although they eventually will pay you, the amount of stress and interest and pain that they create sometimes is not worth it. I've learned that the hard way myself as a business owner. So thank you for that dominant
Yeah.
question, Stefan. Appreciate
Yeah,
that.
of course. Thank you, Aldo. No, just real quick, j- it, I can't ask for everything up front because the hours could fluctuate.
Right.
Net 7, net 14, it sounds like that's what I'll put in my contract.
Absolutely. Yeah, do that. Again, you can request this is your minimum retainer. I would a retainer that works well for you. Incentivize salary payments for you, perhaps, Stefan, that will not work. But also, say, hey, you have negotiated net 30, but if you want to incentivize these people to pay you early, maybe offer a nice discount, 2-3% if you pay within 5-7 day period. That's
Hmm,
worked out really well for my clients as well. Again, give them a little carrot as well, right? It's like, hey,
that's a great tip. Great tip. Thank you, Aldo.
of course, happy to. And automate your invoicing. You guys are working a lot of hours. And sometimes you're just tired. And this is what happens. And I've seen this. Man, I did the work. I finished the project. It looks awesome. And I'm going to my next project. And you completely spaced out to send out that invoice. 2 weeks later, go by and it's like, oh, shoot. Now I got to send the invoice. So now you just gave 2 weeks free invoicing just because you're too busy to even send out an invoice. So make life easier on yourself, automate that process. There's plenty of services there where you can do that. I mean, if you're using QuickBooks, you can do that. Stripe is pretty good. I mean, again, you got to pay money for all these things, but again, have that conversation with yourself. and think about the convenience that they're providing to you, right? So, I mean, Wave also offers it. So there's a bunch of providers nowadays where you can have automated invoicing and billing. Now, if you provide a recurring service, like, I don't know what you do, Stefan, but somebody else who offers like personal coaching, and you sign them up and you charge monthly billing, $100 every month, like clockwork. Boom, that's done. They sign the agreement. They have to pay once, and the money comes in the account and makes it to your bank account. Make life easier on your clients, make life easier on yourself. All right, let's see here, next page. All right. So where does my money go? Like, spend smarter. And I know you guys are smart guys. You guys are ambitious guys. That's why you're in business. But again, in my experience is you're really good at what you do, and you probably had a job doing what you do. You become a business owner, and then you soon find out there is a lot more to do than just doing what you do best, right? Marketing, accounting, answering your own phones, blah, 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 blah type of deal. So this is what I've noticed is lately is I call it death by app. You sign up for every app that you think you're gonna try them out. You get into these free month type of deal. You put your credit card in, you forget about it. Next thing you know, you start bleeding at $20 a month. And I've seen people have like 10 subscriptions of crap that they don't even use. So that's $200 times 12. That's $2,400 a year. I don't know about you, but that's a lot of happy hours, right? Sometimes people are too hurried up for growth, so they start buying stuff that doesn't fit them. It's one of those deals where they made the expense or the investment where they're not ready to take advantage of those things. So I'll give you an example, right? What I provide, the services that I provide is tax planning. Now, really where I make that difference is when people are making really good money. They're in the 32% tax bracket. That's a married couple that is pulling about $400,000 a year. Right now, if somebody who just started as a single guy who's making $30,000 a year and wants to hire me, that's not a smart move for them. I would be the first one telling them, hey, don't buy my services because they're not going to bring you the benefit that the couple making 400 plus would get. So sometimes people, I'm like, this is a smart move. Yeah, it is, but it's not the right fit for you. So always remember, is it the right fit in your current situation? Because sometimes people spend the money on things that they're great product, great service, great concept, but it's just not the right time. So watch out for that, right? Try to look bigger than what you are. I mean, know what you are. Sometimes we just hire people to say we got so many employees. We got so many this, but then you got people doing absolutely nothing for you, or you have a bigger office, right, to make an impression or whatnot. Again, I get it. Sometimes we want to appear bigger than what it is, but at what cost? Have that conversation with yourself, right? Also is shopping vendor rates. If you are looking at health insurance, any type of insurance, I'm sure all of you guys, even at the personal level, the rates have gone bananas. Always make sure that to shop around, at least just to make sure that there is no better alternatives, right? And that could be your rent or services with your cell phone company, Cox. Some of this stuff may seem mundane, but especially when you're getting started, every penny counts. But also another thing you want to shop around, if you have a line of credit, shop the rate out. Have that conversation with your banker. If you don't have a business banker, start a relationship with one. It's most businesses down the line, they want to grow. They want to perhaps, have the objective buy commercial real estate or buy equipment in order, or just have a revolving line of credit. So if you have a cash crunch, you can access that right away. My advice is start having that conversation before you need the money. Banks are really good at lending you the money when you don't need it. So the moment your bank statements look good, your profitability looks good, that's the time that you want to ask for lines of credit and start that relationship. Because, and I've seen this, the moment things go south and you really need the money, no bank is going to want to look at you. That's how they work. What do you want me to tell you guys? But that's my advice. Now, a smart move, right? If you're an impulsive buyer, the 48-hour rule works really well. Make it 72 hours. I know there is, a lot of seminars where you gotta pay $10,000 and they're gonna show you the best way to do business and blah 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 blah. Again, I haven't attended the seminars. Maybe they're worth the investment, but again, maybe having a cooling period is a smart thing to do. Again, nice to have versus need to have. And I'll give you an example. I work a lot with construction companies, and some people love to have brand spanking new trucks that are $100,000 just because it's a nice deduction to have. But the reality is, don't get me wrong, everybody loves a nice truck. But the reality is, yeah, you'd save money on taxes, but you still got to make the payment on that, right? You still have the depreciation on that. I have to tell you, the depreciation on those type of vehicles is massive. So if you need the truck, I mean, do you really need a truck, or do you just want to get another truck just so you won't pay taxes, right? Some people just want to cut their nose and spite their face. So again, just because you can doesn't mean you should, and that's the conversation. It's having a balanced conversation with yourself and your advisors. If you have a CPA, you have an attorney, a banker, have those type of conversations, or a good friend. Use them as sounding boards. That's my advice. Audit subscriptions monthly. I had a client where they had no idea they had subscriptions to their credit card because their son was signing up for a bunch of apps on their share plan in Verizon. And well, they were buying games and everything else, and they were just happily paying the phone bill. It happens. So watch out what's going on, because unfortunately expenses, especially the small ones, 10, $20, but you get a bunch of those, can make a big difference for some of you guys. All right. The next one is, have you guys heard about the profit first concept? Show hands. No one? That's fine. So profit first is a philosophy that was introduced to me a couple of years ago. Where?
Rich Dad Poor Dad, right?
Well, something like that. But again, it's like rebranding, same story. It's kind of like you get $100, you pay yourself first 10%. And it's fine if you already know your cost, right? If you go back and you know that you already have, if every $10,000 that you bring in, you know that $6,500 is going to cover all your business expenses, right? So a good example says, you got to have 10%, you take off the top, then 25% you save for taxes, and the rest, your 65% should cover your operating expenses, your business. If you got that dialed down, this is great, because, it's really going to say, hey, I got to take my profit first before anything else happens. But this is for people, or really pushing people to figure out what your business expenses are. This is what I see though in practice. Oh, they just take the 10% profit part. They forget about the other part. Well, I bring in $10,000 a month, so I'll take 10%, 1,000 off the top. That's my profit. That's mine. I'm going to pay myself first. I'm doing profit first. The catch is that their operating expenses for the business is $10,000. So you haven't solved that problem. We need to solve that problem of, are we making enough money to cover your operating expenses? Then we can have that 10% conversation. But before that, we're playing the liar's game, right? Because you're taking 10% of your money coming in, but you know that your operating expenses are 100% of your bringing in. So it's a great concept. I just want to bring it up because I've been hearing about it lately, and I like the concept. But to me is what's being missed is business owners really have to dial in on the operating expense part to make sure that there is enough meat on that bone that you can take your profit first.
Aldo, I have a question in the chat.
Sure.
After the profit first mindset, some of them are non-profit, so this applies for the non-profit business model, or how it will work with the non-profit business model?
Well, profit first, I think it's a mindset that could be applicable to both the business and nonprofit, and all of them are businesses. The difference is that for profit is a monetary profit. A nonprofit, the profit is a different outcome. It's not a dollar sign, but it's usually client served or objectives met, right? If you're in the homeless, you're helping the homeless is the profit, from my perspective, is the more homeless people you help or get off the street, that's your profit right there. So, I mean, that's the way I look at it. But yeah, profit first, really what I see in the mindset is more applicable to the business, but I can see it being applicable to the nonprofit sector in regards to we want to make sure that we do help X number of people getting out of homelessness or whatever the nonprofit would
I
do.
have a question. I have a question.
Yes, sir.
So I know you actually pay yourself last, and it's kind of weird because I mean, when I pay myself first, I'm talking about the entity of the model of the business itself, and to cover not only the operating expenses and taxes, and later on the profit. But that's why I mean, okay, I'm taking the profit incumbents of the business itself prior to the taxes and the operation, but I am allocating the other investments, so the other investment can create incentive growth for the taxes and the operation. Wouldn't that be sufficiently enough to maintain the conditions of the environment of the business?
That is a really good question, right? And that's the conversation within the profit, I say, because at that point in time, you have to have the conversation with yourself and your advisor. Okay, my profit is 10%. How much do I really want to take for myself? And what other portion do I want to reinvest in the business? So it really depends on what stage in the business you are. If you're a new startup, the reality more than likely is going to be, you know what? If there is any money left, I want to reinvest in the business to make it grow. So later down the line, I can collect a bigger profit, right? So it really is applicable to what stage your business is. If you're already have grown the business the way you want it and you got it humming along, now the idea is that you're able to predict more than likely what your profitability is going to be like, and you are not in that position that you have to reinvest as much in your business. Hopefully, I answered your question there.
In a
All
sense,
right.
I think in a sense you did, just because I'm visualizing that in every situation, it's not only the investments of profitability margins on the day-to-day operation, but also in the future of creation of the business for expansion. So
Right.
even though there may be profit there, I'm not necessarily taking it, but I'm reinvesting it in a way that that money is working for me in capital growth, to
Yeah.
expand to and grow to the next level.
Right. Absolutely. But that's the nice part, right? It's having that conversation. What to do with that profit? There's people say, "All right, guys, our new boat, or we get that house in Flagstaff, or whatever it is," and that's okay, right? Or like you say, you double down and you capitalize your business so you can keep it growing. It really depends on what it is, and that's when you have those deeper conversations with your advisors or with yourself or both. All right, so man, it's 4:46. Time flies when you're having fun, but that's great. Thank you for the questions. Keep them coming. So, all right, things are unpredictable. Again, we got a war of Iran one day, and the next day gas prices go up, and as you guys know, when gas prices go up, everything goes up. But you cannot control that. What you can control is what's within your reach. I'll give you an example. An old client that had a restaurant. They were in love with a certain dish. The problem with that dish was, I guess grandma's recipe or something like that. It was expensive to make. The supplies, it was really, all the ingredients were expensive. Not a lot of people order it. And it was labor intensive, but they had to have it there. Or they could sell a hamburger that they also did really well. It's quick, easy, and fast to make. And that's my example in regards to double down on what's working for you. Sometimes we get stuck into an emotional attachment or a kind of different attachment to a specific service or product that they're great, but they are not the ones making you the money that you need to make your business grow and make it profitable. So double down on what's working and make that decision as much as it pains you. If that's what it is, it's a great recipe for a restaurant or a service that really doesn't make you money. You love doing it, but doesn't make you money. As a business owner, you want to make that decision on really choosing what's making you money, what activity and what product is making you money. And if you don't, please take the time to invest and figure out what's making you money and what's not. Because I've seen enough people spending countless hours doing something that they think they make money on. I think they don't. Right? Again, guys, strategically not a panic. Like I said, you're a restaurant owner, you're a consultant. Figure out what makes you the most money in the shortest amount of time possible. That applies to any business. Have a plan B. Talk to your banker about revolving lines of credit. I believe you guys at Seed Spot, don't you guys have a relationship with some kind of FDIC organizations to do revolving lines of credit, or is it me? Maybe it's Local First Arizona.
Local First Arizona, but we have some resources.
Yeah, so that's great. Talk to your credit unions. Have those people available to you. They can guide you to see what's real or what's not.
Yes.
Yeah, again, say no.
And sorry, you guys can also talk to CPLC, the Woman Business Center, which is our partner on this, and they have the resources that they can direct them. And it says Woman Center, but it's for everyone. So
Everybody's
it's a really
welcome.
good resource as well.
All right. And say no to money losing venue again, what we just talked about. Right. And you have a plan, it thinks, my revenue drops by X number of dollars. What am I going to do? Have a contingency plan. Don't really invest a lot of time, but just have that clarity to be able to be nimble and make the decisions that you need to make in order for your business to be a going concern. All right. So what can you do this week? And every week, really. See what your cash position is. See how much money you got in your pocket. Cut unnecessary expenses, right? So if you have anything that is not adding value to your business, should be in the chopping block. Even if you're doing well right now, this is just good foundational things that you want to do. And again, profit first. If you want to take some money out of your business, open a separate bank account. And remember, guys, there's two buckets: business activity, personal activity. Not talking a lot about taxes yet, but if you are a Schedule C filer for tax purposes, which probably a lot of you are, that means even if you have an LLC and you're the sole owner, you're going to file a Schedule C tax form, which is part of your 1040 tax return. So don't put yourself on payroll. You do not have to put yourself on payroll. What you do to pay yourself is take an owner's draw. And that could be as simple as transferring money from your business account to your personal account. That's that, right? No payroll is necessary. As a matter of fact, the IRS does not want you to do that. Now, when you become a bigger business and you become an S corporation, yeah, you're required to pay yourself via payroll. But if right now you're a sole proprietor or operating as such, you pay yourself as an owner. So let's stay connected. Follow me at Aprile CPA on the social media links. And that's my picture, new picture. There they are. And that's it. That's my website. That's my office number. And answer to happy any other questions that you may have.
Thank you so much, Aldo. Do you guys have any more questions?
All right.
He did a really good job answering all the questions. Thank you so much, Aldo. I really appreciate it. I see a lot of thank yous here on the chat for you to look at it. Thank you, everybody, for being here. We really appreciate it.
Thank you so much. It's been a pleasure. And that's that. If again, you're going to follow up, the best way to get a hold of me is shoot me a message. There's my email is aldo@aprilecpa.com. So if you have any follow-up questions or whatnot, feel free to shoot me a message.
Perfect. Thank you so much, everyone. I'm going to stop the recording right here. And remember, everyone, I will be sending an email and through the newsletters, the links to all the recording for some of the session, including this one, so you can rewatch it again, because this was really good information. Thank you so much for being here today, and we really appreciate it. Have a great day. We're going to stay here with Aldo for the people who wants to listen to this presentation in Spanish. If you're not, feel free to log off right away. Thank you. Bye.
All right, guys.
Bye,
Thank
Stefan.
you.
Bye, Ricardo.
Nice to see you again, Linda. Take care.